Retail sales much stronger than expected this morning. It could translate to better third and fourth quarter GDP, according to economists. Sales jumped 0.7 in September, 0.6 excluding autos. The numbers for July and August were also revised up. My next guest says he's not surprised because of the surge in salaries this year. Joining us now is Steve Odland, president and CEO of the Conference Board and a CNBC contributor, along with CNBC's very own senior economics reporter, Steve Leisman. Welcome to both of you. Steve, let's get right to it. Steve Odland, that is. What are the headlines on the salary front?
Well, you know, CEOs are telling us, and we polled now at the Conference Board over 400 firms. They're telling us that this year salaries went up close to 4.5%. Next year, they're planning around 4%. That could be good news for consumers because if inflation does, in fact, come down below that, then real earnings could grow. And the question is, you know, is the consumer on edge or not? The retail sales data suggests that they're still strong, even though you've got over $1 trillion in credit card debt. You've got their balance sheets worked down from the stimulus payments. So you would expect the consumers to start to be towards that edge. And yet, you know, now we're thinking that real earnings will grow. Our consumer confidence index at the Conference Board fell in September, but that was mostly the expectations index. They're feeling really good about their current jobs, their current salary, their current situation, but they're worried about the next 6 months where they are expecting a recession. So that then finally says, what about the holidays? Because we're ramping right into the next 2 months, and it looks like consumers still have some powder that's dry, and the holidays could be okay.
And Steve Leisman, I think the most fascinating dynamic going on right now is that I have, you know, everyone telling me retail sales is so strong and all this, and the consumers themselves are telling us they do not feel good about things right now. So who do I believe? All the data that tells me things are fine, or the consumers themselves who are telling me things are not?
I think there's a famous phrase, Kelly, that answers you, which is, watch what I do, not what I say. And I'm reminded, Kelly, of the fact that in the wake of the 9/11, the tragic 9/11 events, Americans found themselves wandering car lots, buying cars like they were going out of style with a massive incentive from the government. So, yes, the consumer confidence data can help us with turning points and things like that. But by the way, the data that we've seen on consumers' views on the economy are all terrible, but we're just not seeing it in the data. And just a couple of quick things, Kelly, I want to update you on, which is first, the Fed probabilities now with this report this morning have gotten a lot stronger, not necessarily for November, but January is now in play. We are now, I think for the first time, above a 51% probability, above a 50% probability for a rate hike now in January. So that's been pushed forward. And I want to read you this quote here from our friend Jan Niffen, who you know is one of the best retail watchers out there. He sent me a note this morning. He said, "Come on, Steve. We bashed the consumer, pardon me, with the fastest increase in interest rates in history. We bashed them with the fastest reduction in the money supply in 90 years. We bashed them with the highest inflation in 40 years. We bashed them with the war in Ukraine and now war in Israel. We bashed them with the worst presidential matchup in history, and they just kept spending." So I'll leave that there. All
right, Steve Odland, maybe you should jump in here and explain, you know, that the salaries are one place this spending power seems to be coming from. And here again, I'm in this mood today. I'm going to say, but it's lagging, right? We often see strong salaries as like a delayed indication of what's going on in the economy. So can it really kind of keep things going here, or is it? I don't want to call it the last hurrah, but something like that.
Well, you know, you have an unusual situation because it's a Fed-induced recession that is being projected here, but it's still a tight labor market, and we've got a lot of skill shortages. You have CEOs banking talent, so people are feeling pretty good about their jobs, and they're not feeling like that's at risk. And when that happens, they tend to spend, and they spend based on their own cash, but they spend also based on real earnings growth, and they're using debt. And I think that the debt numbers are going to go higher. The consumer credit card numbers are going to go higher because they want to do this. And you're coming out of a pandemic where everything was shut down, so you're seeing services continue to grow and experiences, travel, restaurants are continuing to grow. So all of that's happening. Now, one thing to watch out is that we just had this student loan payment come back on this month in October here for about, over 40 million debtors that need to then fit that into their budgets as well. So that's one watch out. You also have CEOs saying there's going to be a recession. You have 70% of CEOs saying that there's going to be one more rate hike, and that syncs up with the Conference Board's own estimate, which is that there's going to be at least one more rate hike in the fall here.